Good morning, everybody. Thank you for joining this webinar today to talk about shallow loss coverage options. To my right here, I have Mr. Lee Waters, and to my left, Megan Moses. She's been a crop agent here for 7 years. Lee's been here for 18. We're going to talk about increasing liability with the shallow loss coverage options available. If you guys have any difficulties, on the screen here, there's a number to call with an access code. Your mics are automatically muted, and we appreciate you joining this meeting with us. Oh, I'm Nathan Shear. I've been with Farm Credit Crop Insurance for 6 years now. You guys want to kick this off?
Yep, absolutely.
There we go.
So when I think about shallow loss coverages, I kind of think of them into layers. And that first one being the supplemental coverage option. So SCO was the first opportunity that farmers had to pair an individual-based policy with a county-based coverage. And that came to us in the 2014 Farm Bill, allowing producers to start utilizing this in 2015. So how SCO works is it works off of an expected county yield that RMA establishes every year. And then it uses the same corn and soybean projected price set during the month of February as your individual policy. And then at the end of the year, it will use the final county yield that RMA collects after all production has been reported for the county. And then it uses the same harvest price that we set in October that your individual policy uses. And so SCO, there's a few changes coming to SCO for 2026. The first change is an increase in subsidy. So prior to 2026, SCO has been subsidized at 65%. Starting in 26, that subsidy will increase to 80%. And along with an increase in subsidy comes an increase in coverage. So if you took SCO in 2025, SCO would take you from where your individual policy ends. So if you were 80% coverage, it picks up at 80 and takes you to 86%. Starting in 2026, that will now pick up at 80% and take you to 90%. And then the last change that we are seeing for SCO is that it's no longer tied to a farm program. So 2025 and prior, in order to utilize SCO, you have to have used PLC as your farm program election, which in my area, ARC is typically the more common option. So that's a barrier for a lot of our producers to use SCO. But starting in 26, that is no longer a requirement. So I think that's going to open up the opportunity for a lot more producers to be able to use SCO going forward. The next kind of layer that I think about when adding the shallow loss coverage is ECO. So Nathan, can you tell us a little bit about ECO?
Yeah, so ECO is an enhanced coverage option, and it's going to start where SCO stops at 86%, and it's going to go up to 95%. You can buy it at a 90% level or at a 95% level. It works exactly like SCO as far as it takes that county expected yield and then the price we set in February, and we use those two to increase liability. Okay. The subsidy with ECO as of now is remaining the same. It's really, we've really just been, it's a great option for individuals to increase liability with the understanding that that upper echelon of coverage, that band between 86 and 95 is based on how the county performs and what happens to our price. There may potentially be some changes coming in 26 for ECO, but we're not certain of that as of right now. And then lastly, one of the big reasons we're here to talk about is a margin coverage option. So Lee, what do you think about margin coverage option?
Sure. So margin coverage option, as you can see, everybody looking at this slide right now has a very similar look to ECO. This product is going to cover that same county band. As of today, it's going to be from 95 to 86%. The big difference between this and ECO, though, is a little bit different with timings of how prices are set and how liability is established. So first of all, one major difference is, you can see up here, if it's something somebody wants to participate for 2026 crop, The sales close date sign up is September 30th of 2025. The reason that is earlier, which is coming up here in about 6 weeks, the reason that's earlier is the projected price has a different time to set. So all of our other spring products out there, RP, ECO, SEO, all these things we're hearing, always use that February month to track the forward price. So for instance, last year, your 2025 corn crop was tracking the Dees 25 futures during the month of February. So what margin coverage option is doing is right out the gate, it is tracking, and I'm going to use corn as the example, the Dees 26 average starting yesterday, August 14th, and it goes through September 15th. So one of the differences is it's using a different window to track price for that specific product. It also has the same subsidy level as ECO. Another big difference, and a little bit of this comes back from the using of margin protection in the past, it is called margin coverage option because you are ensuring a net margin instead of a net price, because what it's doing is also tracking some input costs. You see them listed on here: diesel, natural gas, DAP, urea on corn only, and potash. What it's basically doing is you have a set amount of liability, the 5% comes off the top, and then on the bottom side, you have 5 inputs that are being tracked, and that establishes a net number, the difference. The way a claim would be paid then is either A, the margin is shrank down by a decline in price or yield, or inputs go up from now through April. So the rest of the calendar year, this looks like is your spring price is set now, your inputs are set now. April of 2026, they retract the inputs, and then in the fall of 26 in October, we track the fall price and establish the final. So the way this looks as of right now, this is not quotable yet. My thoughts on this are the differences between this and ECO really is going to be driven by your opinion of price, of where we are today, of where we could be in February. So, and the big reason we're talking about this today too is all of these products have definitely been gaining popularity over the last several years. The big reason, in my opinion, is just due to the fact that it's the only way to buy up above 85% with a subsidized product. There are available products out there privately through each insurance company that you can buy up to 95% on an individual level, but they are more cost prohibitive because they're not subsidized. So in the last few years, SCO had some popularity, especially in the mid 22, 23 in my book, due to the fact that premiums were rising on your 80 and 85s. So SCO was a more cost alternative way to reduce premium and still keep liability up. ECO definitely last year with the increase of subsidy became massively popular in my book of business for the fact of just being able to increase liability yet, reduce trigger, reduce deductible with a subsidized product. So, any of you have any opinions as we're talking today on anything?
Yeah, so in my area, a lot like what you said last year with the increase in subsidy with ECO, it became very popular. Also, input costs were substantially higher this year, so a lot of people had a high level of liability out there. So when we sat down at the beginning of the year and had conversations, in my area, 75% is very popular. I'm at the very southern end of Illinois, like the lower 10 counties, and we were guaranteeing somewhere in the ballpark of $650 an acre and 75% coverage. So a lot of producers, that wasn't enough. And so we sat down and started talking about what our options were to increase liability. With ECO being subsidized, there was an ability to add somewhere in the ballpark of 90 to $100 an acre worth of liability onto that 650, bring them up there around $750 an acre. As Megan said earlier, SCO wasn't as heavily subsidized this year as it might be in the future. And so when we had that conversation around SCO, we really talked about we got in the conversation about their county products, ARC and PLC. and we talked about what kind of guarantees they were receiving with those products as well. And we kind of rolled that all in as a bundle and said, okay, if your 75% coverage is going to guarantee you 650 an acre, if we take ECO, we're adding another $100-ish an acre worth of liability. And then when we looked at our county, there was somewhere in the ballpark of $80 to $100 an acre worth of liability included in our county. So it kind of gave producers the option to go all the way up to somewhere in that $850 an acre range and safe going into this crop year with a lot of unknowns. The other thing that makes ECO look advantageous in my area is we do have, the Ohio where I'm at, and there is a lot of high risk ground. So in that scenario, insurance premiums on high risk acres are a lot higher than what they are on standard rated ground. ECO premiums are the same. So on high risk acres or on standard rated acres, you're paying the same amount of dollars for ECO. So it was a way to really increase your liability on those high risk acres without incurring a ton of cost.
I really like it. It's really like building blocks of putting your coverages together, and it gives you different. I guess I call it, because we're from the farm side, like a mode of action. And just to instead of having just like an 85%, kind of putting different products together. If we could back up to that ECO slide, I kind of want to show like what this year, what really looked good in Champaign County. Just one more here. So what you see here, everybody, is you notice like in this specific slide, you'll see an 85, an 80, and a 75. And you notice there's, as you reduce, ECO stays put at that 95 to 86. The big thing with this is being open-minded to the fact that you can stack these things together at different premium levels using it, taking your subsidy to your advantage. So for instance, just looking at this, Champaign County corn at 25. RP85 was probably in the ballpark of $28 an acre by itself. ECO by itself last year was $18. The big change was the year before that, it was like 35 bucks because the subsidy was changed from 48 to 65. So walking into 25, we're looking at, okay, we happen to set our high in February this year. It just happened to work that way. And what's a better protection, in my opinion, is it, do you want to have to drop 15% down to 85 only to trigger a claim? Or do you drop just 5%, although on a county level, the chances of dropping 5% on a yield and or price combination are much higher, even at a county level, than dropping at 15%. So what I had a lot of people doing is, instead of buying an 85 by itself for $28, I had several people that would go down to an 80, buy it for about 14. It is half price. It will trigger less often, but 80 has a higher subsidy ratio than 85. If you look at that over a long period of time, your 80 probably will be a better value in most situations in my area. We're a very consistent county. What I tell my producers is that 80% part of your policy is for that 1 in 10, 1 in 20 year, sometimes once in lifetime event when things are really bad. That producer, that's what that 80 is for. Then the ECO is what's for your every other year type situations. Like this year's a perfect example. We've dropped from $4.70 to $4. Okay, we should have a decent crop. It's going to vary by county, but a 70-cent drop in price will very likely trigger a claim if our yields are not very, very good. So back to my point, I have producers spending 14 on 80% and maybe 18 on ECO together for about $32 instead of 85 by itself for $28. Basically very similar premiums. So there's some flexibility with this. You can also buy liability down on ECO, and you can actually do it on margin coverage option and SEO too. Right now you can see that ECO. So that ECO right there is probably worth about, on a typical grower in Champaign County, roughly $100 acre of coverage if it paid out completely at 18 bucks. You can actually decrease life. Had some customers who may have done lately. Lee, $32 is a little much. What can we do to maybe get it down a little bit? Go down to maybe a 75% line. Instead of spending $18 an acre for $100 of coverage, you probably spend roughly about $13, $12, whatever the math is, $13, $14 an acre for $75 of coverage. Still pays at the same time as your ECO at 100% liability. You're just getting 75% of it. So you have a lot of flexibility with that. That's what's really intriguing about it. I've also treated this year as a way to kind of set I guess you'd call it a put option. I look at 470 spring price, and if all things are normal, let's say we have a normal crop, APH, it's not great, it's not bad. It's like Champaign County has a 228 expected yield. If Champaign County comes in at 228 this fall, which it could, we'll see when the time comes. Price, if it's under 442, we'll start triggering. You only have to drop 5%. For your RP85 to trigger at APH, you're going to have to drop under $4 to start triggering. That's where I'm kind of looking at that is for the value. It gives people a little bit different look, maybe a little bit more activity with their insurance, gives them a price floor. And if you're in a fairly consistent county, or if you're fairly consistent with the county, you may trend with that. Although as of this last couple of years, that's became less of an issue with most of my growers. They're looking at that triggering being higher.
So the same conversation we had down south, when we started looking at ECO, it was like the loss ratios, because unlike Champaign County, there's a lot of variability in the yields we experience down there. Weather plays a huge factor. Our soils can't withstand the dry weather in the summer. So we see a lot of yield variability. So when we started looking at loss ratios with ECO, in several counties that I service in Southern Illinois, loss ratios were north of 200%. And then you look at, we had the ability when we were quoting these products to sit down with producers and show them, okay, your 75% coverage or your 80% coverage. Like we said, that's something you're purchasing for that 1 in 10 year event.
Yep.
1 in 20 year event that could potentially, this insurance, your underlying coverage is what keeps you farming. It was kind of nice, just like what you said. This is setting a floor on the price, and with our variabilities in yields, I was showing them, some of the only time that triggered was in 12, but it wasn't farming in 2012. Yeah. Where ECO, when you start looking at a 20-year historical average, it might have triggered the last, it might have triggered 10 out of 20 years. Right. So half the time, you're at least getting something back with this product. What about you, Megan?
I think in our area in 25, ECO is definitely the more popular option of ECO or SCO, mainly because, like I said at the beginning, you had to have PLC elected. And last year in our area, a lot of people were using ARC to fill in the gap up there between, the 75 or 80 up to the ECO level. But also, our area doesn't necessarily, parts of our area have very common yields, very similar ground. Other parts of our territory where I'm at have a huge variability. So a lot of the conversation stemmed around, is this the best fit? And we've talked about a lot of the situations where it was the best fit. But also there are some situations where it may not be the best fit. One of those situations is prevent plant. I usually do tend to have some prevent plant every year somewhere in my territory. And so if you're a producer that experiences those types of losses, maybe we're better off investing those dollars in your individual side. Yeah. Then also in 25, what happened in my territory was RMA readjusted a lot of the high risk areas. Yeah. So when you have high risk ground, you have the ability to break that off onto its own policy and insure that separately. But in 25, when a lot of that ground came out of high risk, we no longer had that ability. So we had to kind of go back to the drawing board and sit down and figure out, how do we actually need to structure our liability to be able to keep that ground separate, to protect ourselves on some of that high risk ground. And we did a lot of switching from enterprise units where we're ensuring everything in the county is one, kind of dropping coverage a little bit to manage premium, but then switching to optional units. So there's a lot of situations where it works. I think there's also a few nuances maybe where it doesn't work as well. And I had producers in both spots last year.
I think what's important, and if everybody on this video can hear, all of us really take this case by case. When I sit down with a client or a producer, we look at these lots of different ways. And I look at it as how are you allocating your premium for the year? You can buy everything you want for $100 an acre if you really want to. But let's say you want to spend 25 or 35. I want to look at what can I do with $35? What can I do with 25? What's the best place to put that premium? And that's what you can hear right now, Megan talking about whether that's a better investment to go to optional units or not, or whether in my area, should you drop coverage at this or not. Everybody's different, and that's what's okay, because everybody's got different operations. And I think at Farm Credit, us just being in crop insurance, we can focus on that. So bring us back to the MCO slide. I just want to kind of revisit that again, because of course that's what we were talking about today. Before we get any further, go to the next slide, actually. So as you can see on this slide right now, you're seeing this SCO overlapping in MCO and ECO. So one of the things when we talk about potential adjustments, before we get into further discussion. So right now, as you heard us talking, SCO used to go to 86. With the One Big Beautiful Bill Act on July 3rd, it was mandated that is going to go to 90% now with an 80% subsidy. I do feel that's going to be a very attractive option for 2026 to consider. What we're going to have to wait and hear on, obviously, as you can see on this chart, these MCO and ECOs are now overlapping into those covers because they come down. So some changes we need to wait to hear on is are we going to see maybe those change their band of coverage? Could we see maybe ECO next year go 95 to 90? Maybe. We don't know that yet. Will they allow them to overlap? They could. Those are some things that we are still waiting to hear some direction on. But what I want to focus back now on, go to the MCO slide, is if you're looking at this, why are reasons I would look at this versus something else? So back to the projected price period. If you're one that's trying to maybe eliminate an unknown now, I've had some margin protection policies in the past and still do. Margin protection kind of felt like this. It sets that projected price during this period. My producers who bought this, that was a big reason they did. They may have been looking at, for instance, 2023, where they set a 509 spring price with that margin product. And then in the February month, it ended up being, 466, I believe. Or I'm sorry, yeah. So, and then, but then the following year it could be different. So it's kind of like marketing grain. Risk management, if you're trying to hit a home run with it, it could either be a home run or not. But if you're wanting to knock down one unknown, is setting price now versus February, this could be an option to look at. The other interesting part of it is the inputs. So when you think about this, so the way that usually works is the big movers here. You see there's 5 inputs here. The ones that move the needle, when I say move the needle, affects the policy very much so if they move, is DAP and urea. Let's hypothetically say your MCO policy, when you take your expected yield and price, we end up with a number that's maybe, let's just use $1,000. We take the 5% off the top, and let's say that number is $50. And then on the bottom, these inputs, and if we ran them we've been able to look at a 25 quote, although that wasn't available for 25, we can see the numbers working. Those 5 inputs end up being about $150 worth of cost. So what you've got there is you take 50 off the top, 150 off the bottom, and you've got an $800 number in the middle. That is what the number is you're insuring. So let's say DAP doubles from now to April when urea doubles. That number, that 150 on to 200. So now what's happened is that $800 is what you've insured has already shrunk to $700, and you've taken that off the bottom side. And then what happens in the fall, it affects it at the net difference. If that number is less than that 800, there will be is the maximum liability of the margin coverage product. So as I said earlier, and I'm using very round numbers here. Let's say that blue box of MCO is worth $100, $100. If the price is less than the spring price, that's the max it'll pay. So if there's a $300 loss in margin, you'll get 100. If there's a $20 loss in margin, you'll get 20. So as I said, has some interesting things. We were sitting around talking about this over the last few days before this webinar, discussing some hypotheticals. I think if you're looking at this, and Megan, we were talking about this specifically because you brought up input costs as one of the interesting things about it. If you're using this as risk management for inputs, this is probably, you're looking at maybe waiting to buy your inputs. It's also not the exact same cost as the inputs you buy. You got to remember, if you're a say you buy at the terminal tends to follow the board more. So these inputs follow the board price. Your terminal cost typically follow. If you're buying from a retailer, if a retailer buys urea in July, if you buy it in that summer or you wait till the winter or wait till the spring, it's very likely going to be what it was unless that retailer bought more to adjust their costs. So I've told people too that that's something to think about when you're doing this. I mean, if you're buying this now, then you need to think about what you're doing with if you're buying your input cost, if you're buying your DAP and your nitrogen, whether it's gas or if it's 28 or whatever you want to do. If you're doing all that in the fall for the next year, I wouldn't be focusing on the input side of this as your main reason. I wouldn't say that's not why to buy it, but that's not the main reason. I do feel the strongest reason you're looking at this is the different look of when price is set. I don't know what your guys' thoughts are.
Yeah, I would agree with that. When this first came out, we were all in a meeting in Mount Vernon, and the conversation was, well, why wouldn't I just wait to take ECO?
Sure.
And that was pretty early. Like I said, I think that was back in July. And everybody kept hitting on the price factor. If we come at the end of a summer rally, and if I could lock in a good price, I might as well lock it in on my band because I still have the opportunity to set my individual coverage price in February. Yep. So I'm getting the benefit of both pricing periods a little bit.
Yep.
No, I agree with that.
Yeah. And so that's the other thing to think about too. You can have inputs drop. Let's say, and usually what you see, and this is fairly, you can track it historically. Right now I'm not, our price today, I believe DS26 is probably in the 440s range. Let's say prices continue down. It's probably likely that inputs are probably going to follow that down too. Although the inputs dropping could widen margin, the price you set now will be beneficial to you. So although inputs would drop and widen it, that price is probably will be better than February. Now vice versa happens. Let's say today's our bottom, and this is what happened kind of last year. We set a 440 price last year on margin protection, which uses the same window, and then we went through an October rally and we got to 470 in the spring. What happened with the margin product of the before is, although the price was lower in September, the margin did get squeezed a little bit because the inputs did rise on the board of trade. They tend to follow commodities. So as I said, the big driver, I think, is the earlier setting of price. I can't tell you whether it'll be the high or low. That's part of risk management.
So we had the opportunity, I was up here yesterday and we were talking about some of these shallow loss coverage options that people purchased for the 2025 crop year. And we were talking about the changes we've experienced since setting the price in February at 470 and kind of what some of these products that people purchased going into 2025 look like as of today. And we had an opportunity to speak with a grower on that. I was fortunate enough to sit in the meeting with you. Do you want to talk about that a little bit with some, just what things look like as of today?
Sure.
If you were somebody that purchased, ECO or margin or SCO,
anything,
our county PLC, like what do those look like?
Sure.
There were some changes made in that as well with the one big beautiful bill, correct?
Yeah. So just sitting here where we're at today, now we're focused on 25 crop. Corn, we set a 470 price in February. Today, and I haven't opened markets this minute, but we're sitting at about 4. And we're probably going to play in that range for a while. USDA announced a 188.8 expected United States yield in added acres. I know sitting in February with my growers, when we were talking about our coverage, drought was probably the biggest thing. And you never know, it can be. But I said what also happens in dry springs is fit planting conditions. And my biggest concern was the Dakotas and Minnesota. When they are dry early and the corn market is telling you to plant corn, they will plant corn. And that's what happened, unfortunately. For us, what happened, that's where the increased acres came from. So what my thought was with my growers was the corn market is telling us to plant corn now in February. And there's a very high likelihood of high acres. What if we have good growing conditions? We'll have the biggest corn crop we've ever had, and that will be detrimental markets. That's kind of where we're at. And I was using the ECO product more to protect against that than drought. Now, drought, everything pays. I mean, I don't care whatever you buy up here. If you buy an 85 or a 75, if you have a 2012 again, it's not going to make a difference. This stuff's all triggering. But when we have drops in price with above average, even above average crops, your margin's still going to be tight because it's not going to be there. Because all these inputs that we bought for last year were based on a lot higher price than today. So what we were talking with my grower is, I'll just use Champaign County again. Today, let's say $4 is the October price, and that is what happens. So the ECO product would max out, which means pays down to the 86 if we're at 230 bushel county yield for Champaign County. That's basically Champaign County's expected is 228. The high end of it is around 260. So likelihoods of that happening if we're at 4 will happen. So my thoughts with my grower was, okay, the way you got to treat your insurance today, and this is for any of you out there, no matter what you bought, is knowing where the trigger is at today's price. Doesn't necessarily mean to be acting on it yet. What I'm looking at is if we rally in October, the insurance payment will decrease, but you're going to replace that with value of your crop. So you need to act accordingly if that happens, and that's how I treat this as a put option. All your crop insurance is basically a put that expires the end of October. Whatever happens after October, if you drop $1 on November 1, you're not covered anymore. So I use this as a way to, as we get into harvest, watch that. We're going to be watching that October price average. If we stay here or keep going lower, that payment is likely going to increase because price revenue is driving this. But if we route, like last year is a perfect example. We brought it from where I thought we were going to be like at 390. We ended up at 416 last year. But it gave us some opportunities to make some sales and catch up sales in October through November. So that was the main thing I drove home with him, with my producer yesterday, was knowing that, make your marketing plans accordingly. Maybe make some offers in higher. And then maybe work around that. Use that to your advantage. Bean side, we set a 1054 price. I feel we're probably going to rally back to that. We're probably in 1030s and change right now. Obviously, when the USDA report says more corn, more acres, the other crop got less acres. And so the bean acres got decreased, and we've seen an uptick in bean prices recently. So what I'm looking at on the bean side is once your fall price is at or above spring price, you're looking at the yield trigger only of your policy. So like ECO and beans for Champaign County has a 70 bushel expected. So 67 bushels or less would trigger a payment on ECO if we're at 1054 or higher. A lot of that's on IPIN is going to determine by August rains. If we get some August rains, I think we can beat that. If we don't, we may not. And so once again, a way to use that, knowing where you're at, this kind of helps you set floors with that. And so that was the big thing we talked about with that. We'll probably get into ARC and PLC in a little bit. That was also part of discussion. But while we're still on this slide, either of you have any thoughts on this? With how, like I I was saying about this. The RMA has really given us a lot of tools now to let growers be pretty flexible with different ways to increase coverage. So,
Well, one of the things that I enjoy about getting to talk to you is we work in the same state, but like the areas that we service are totally different. And so this year, uh, down south, we had a really good planting window the very beginning of April. And so me and you talked about it yesterday. We're going to have two substantially different crops, I feel like. And it's going to be very specific to when it was planted. So I've got some producers that may end up having some of the best corn yields that they've ever had based on the rainfall we got early this summer. But that rainfall that we got early this summer, if you didn't have your crop planted, down my way, we experienced a lot of prevent plant, like Megan talked about, and then we had some corn that was failed, that got too much rain on it, and it ended up being failed. And then the crop that was planted late, especially corn and even soybeans, it's struggling. I mean, so I think that we're probably going to see a lot of variability in those expected county yields. So that's what I've been having conversations with guys. Like I said, you're looking at prices around $4 today. And we had a big year with ECO in my area, and I've gotten a lot of phone calls about, hey, what does this look like? 30% of the county was prevent planted. How does that factor into ECO? What's it look like with the price today? Was this a good decision? So
a lot of people, I always try to make sure everybody knows too, the final county yields established by ECO, SCO, margin coverage option, margin protection, all the RMA products, they're based on every single policy in the county, regardless of agent or company. It's a very accurate number, and it's based on everybody. And that's where also the county products before used to be based on mass survey. The ability now for all the companies to combine all their production, and this is one reason when we talk about when these pay, we can actually address that now. So when I think about all these products, think about a calendar of events. So February is when you picked your RP, or if you did SCO, ECO. If you did a margin product, it was even before that. We get to the summer, we get to the fall, we set our fall price, and we harvest our crop. These green boxes, these RPs, is what get worked first. Those are your farm. Those are worked when they're worked. You may be paid in November. You may get paid in the winter. It's hard to say. It's when your claim's finished and maybe when you wanted to get paid. All the county plans are then paid in June. The reason it's June is we have till April 29th to collect yields, whether it was in a claim or not a claim, with your company from the year before. So then after April 29th passes, all the production's been signed off on. That month goes by to basically get everything tidied up, and then in June, the RMA releases that county yield. That county yield is based on everybody. And so when you're talking about how prevent plant effects and stuff, really what they're looking at, they're going to look at the planted acres.
Correct.
And so, but I do feel strongly, that number is a very good number. It's basically the largest surveyed yield in the country because it's based on them. And we have a very high crop insurance participation rate. So that's what's really triggering me about that. But yes, that's some things. So when we're talking about, like, and Megan brought this up, we're talking about like how prevent plant works with this. Say you're an 80 today, your prevent plant's based on your RP product. So if you do drop your RP product down, you are dropping your prevent plant coverage too. So those are some of the things like we just talked about. Prevent plant Champaign County has happened one time in my career. Prevent plant in your counties can be a little more often than that. And so, yes, very important to think about all those different scenarios when you're talking about this stuff. So,
yeah, I think kind of what we're trying to drive home maybe is there is ample opportunity and ample amount of products now that we can play with, stack these together, layer them together. A lot of the conversation with my producer starts with what's your break even? What dollar amount do you need? And then we go to the drawing board of how can we get there and how can we get there? Usually the most cost effective way with these conversations of prevent plant and high risk land, things like that. But I don't want producers to be afraid to explore these options. And I think these can kind of get very overwhelming if you're not super familiar with them and maybe this is the first time you're hearing about them. But, and I'm not saying this is a fit for everybody because there are situations where it's not, but I don't want somebody to just throw these out and not consider these.
Yeah,
And
absolutely.
miss out on that opportunity because a 95% trigger, it's a big deal.
Yeah, I'd say, yeah, as I said, MCO will probably be, and as I said, once we know, because as of today we can't quote it, it will be opened up here. I do feel it'll probably look like this for this year because making a change this late in the game, we'll see how it goes. But I'd say right now to expect a 95 to 86 product, and then stay tuned and see what it looks like. When we know county yields, we'll start talking about that. But keep open mind about it. I do think going into 2026, the SCO change is going to be a big deal. What's really big on that, though, as Megan said, my slide earlier where I showed ECO with no SCO in it. The reason was all the Ark County participation. The big deal, the big change now with this SCO going to an 80% subsidy. So when we say 80% subsidy, the total premium, let's say it is $30, and I'm just throwing numbers out. Before, what happened was the government paid 20 and you paid 10. Now you're only going to pay 20% of that number, which is 30 divided by 5 is $6. So your $10 product is now $6. And so subsidies drive decisions with crop insurance. That's going to be something that's going to be really interesting to look at because we're going to talk about RP, but not having to choose a program now makes that really intriguing to look at. There could be maybe next year where you may see somebody's like, I like MCO, but I like SCO. If they allow us to take those together, you can see on this chart, you may layer your MCO at the very start and then pack that SCO down the middle with a very, very reasonable premium and then take your A or whatever underneath. It might be ECO instead, whatever it is. There's going to be a lot of interesting ways to put this together. We were talking earlier too, Nathan was talking about our meeting yesterday with my client about the differences with what's coming. We have some time to run through some of our PLC changes. We have a slide here. So when we meet with our producers, the Title I programs, which is your ARC and PLC, is about as important to make that decision as your crop insurance. And so the big change that happened prior to July 3rd, the One Big Beautiful Bill Act had a lot of farm program stuff in it. Before July 3rd, when we sat with our person, you got to realize now too, your ARC and PLC decision in FSA has the same exact deadline as crop insurance, which is really convenient because you can use all these tools for your risk management. Before July 3rd, ARC has always been 86% of a 5-year Olympic average of your county yield and the national average price. So the national average price and the crop insurance is looking at spring price, fall price, 2 quick snapshot pictures of price. The national average price for, let's start with the 2025 crop we're in. They'll start tracking it in September and it'll go all the way to August of 26. I always tell my clients who are asking why that, like you put some corn at the elevator and you keep rolling the basis in the further months. When you get to August, the final year, that is when the crop year rolls. It's the same methodology that the USDA tracks in the United States every month. So ARC, before this change, and I'm going to use Champaign County again, for 2025, it was somewhere in the 960s. So $960 was the combination of math, and it had a maximum of a 10% drop. So 86 to 76. When they changed it in July, 90%, they basically increased ARC 4% higher. That number is now $1,013. So when we're talking about triggers, you get with ARC, 1,013, use that number. your final county yield, which is the same county yield RMA uses, times the final national average price. If it's less than $1,013, there's going to be a payment. So throwing some quick math around, like 230 bushel corn and use like $4, you're under that. So there's a very high possibility now. It looked like it might be in the money before. It's just second big change, price loss coverage, PLC. This was the other program you could choose from. What they did is they changed the reference price. You'll see here 426. That was the number we were going to use starting this year. And what that number basically is, it started at 370 and had some multipliers built in. It's got some math that uses the last 5 years. And if it's higher than 370, it's got a way to bump that up. And 426 is where that hit. So basically what it had prior to July 3rd, if the national average price was under 426, you got to pay the difference times your PLC yield at the FSA office. Many of you proved those about 6 years ago. That number is now 442, which is bigger. The huge change for 25 is, regardless of the program you sign up for, you're going to get the higher of these two programs if they pay. And that's just for 25. So, for instance, example, let's say ARC pays $60 an acre and PLC pays $80 an acre. And we have mostly ARC participation. They're going to get 80 now. All these also pay on base acres, not planted. So for Central Illinois, most growers in my county are probably on a 100-acre farm, probably have 55 acres of corn base, 45 acres of bean base. It's based on historical planting. There are situations where you might have all corn base on a bean farm or vice versa. As you move south, you're going to have multiple crops with bases. So I'm kind of talking corn. Nathan brought up an example yesterday of a farm that probably had 5 crops of base. Base acres is based on a snapshot in time, what crops are planted over that time, and what the average acres were.
And that was when we had the discussions in February about deciding with ECO and SCO. And that's what's so important about having an agent that understands these programs. So in my area, that was one of the big things we talked about was, when's the last time that you reported PLC yields? And a lot of my guys were like, I don't know. I don't even know the last time that was done.
18.
Well, and they might not have even done it then, Yeah. So it was, and then do you know what the base acres are? And there's farms down our way that don't have a corn base or vice versa. So
Sure.
It was that kind of threw a wrench to see like, okay, well now we don't know. So then our county became even more advantageous potentially. Which, like I said, with the big change, with the one big beautiful bill being able to take the higher of the two, they're going to get the higher of the two. That relieves a lot of that stress, I guess.
Now for 26, you will pick a program again. But as we said, prior to this time, if you wanted SCO coverage, you had to have your base. You had to have the base of that farm number enrolled in PLC. What we want to do. Looking at 26, 442 looks really attractive. I will tell you on Champaign County corn for 26, the way the Olympic averages work, we're going to go from to probably, depending on some finalized numbers, 1,053. So both are really ballooned up. And what happens with these programs as we're riding prices up and start coming down? So like you can attribute a lot of this to 21, and we had really good yields up here.
Mm-hmm.
So the reason these programs, they follow that math, they're peaking as we're kind of maybe coming down into a lower price environment. These are going to be very advantageous, and they are much more now than they were just a month ago. So same thing. Just look out for next year. Last year, I did a little both. You can do that. You say you got 10 farm numbers, you can put 6 of them in Ark County and 4 of them in PLC if you want to. You can do a lot of different things. I was going to tell everybody on this video today too, if you really want to know your base acres, when you go in and sign up your farms at FSA, you get a form that lists your shares, and it does list your You list your base of each crop. If you really wanted to get some reading done, you can actually look through that and find that, and it shows you that. So the other thing to keep in mind with this, let's say you've got 100 base acres of corn on a farm, and there is a $100 payment. They're going to pay you the $100 on 85% of your base acres. That's just another number in there. So what would happen is a 100-acre farm with a $100 ARC payment is going to get $8,500 because they're paying $85 on the 100 acres. So some things to think about. It doesn't match up exactly. It's going to work pretty seamlessly. Obviously, there's a lot of different things with it. Beans had the same thing. Beans jumped to 90%. The PLC price went from $9.66 to $10.71. So going to be really intriguing this next couple of years. And what we'll probably see if we get into a depressed price environment for the next few years, these numbers eventually, probably in 27, 28, will start to drop because they are using averages for the product.
Yeah, I know a lot of the growers that I discussed with the last several years when it came to these county decisions. It was like, I was told it didn't matter, neither one was going to pay. And so, like I said, going into 25, that was a big conversation where it was like there is a probability that one, if not both of these products will pay. Now, obviously, we're getting the higher of either one, and it's going to be the same going into 2026. So that it's definitely something to have a discussion around. Make sure that you understand these products and how they're going to work best for you.
Yeah, I think you guys have said it pretty well. There's so many things to consider. And maybe even when I started 7 years ago, the conversation was, like you said, neither one of them is probably going to pay. Let's do an individual 75 or 80%, and we moved on. But as RMA has given us more opportunities to use a lot of these products and see how they fit together, it's more important now than ever as we're kind of in more of a tighter margin area to make sure we're really paying attention to what's going on.
I think what the drive home from this is, obviously we talked about some products today. It's okay to start thinking about 26 now, whether you're going to buy MCO or not. We may have a lot of conversations with people that we may take a look at MCO and go, I'm going to wait for ECO in the spring. Completely fine with that. But if you want to do this, you can. But it's okay to start planning. I think it's going to be very important for producers to be planning now for 26. We got a lot to bite off of 25 too, but it's very important to know kind of where we're going. Some of the things we don't know yet either, but that's what I think is really advantageous about us is we really watch this stuff hard, and we're game planning today of not just what we're thinking we're going to look like for this crop, but what should we be looking at for next crop already? What can we do for our producers to make them successful with their risk management, to do the best things we can do with things that we pay for with crop insurance and things that we get with the FSA, with the ARC PLC, and how do we package all that together? Because it's maybe not the same for everybody, and that's okay. And sometimes it's going to fit a group of people well, maybe a certain individual well. And that's the best part about this is just it can be a little different, but there's a lot of good ways to this all needs to be related together.
Yeah. So I guess kind of wrapping up what I was talking about, the big thing is it's very advantageous to a producer to work with an insurance agent that is confident on all these products so that you can sit down and come up with a strategy. I felt like, when I sat down with these producers, this is a partnership. Like, tell me where you're at. Things look like, what's your bottom line, what's your cost of production, and let's talk about how we can get as close as we possibly can to protecting that number. And so this year it was different, with high input costs, it was expensive to put a corn crop out, and so there was a lot of risk out there on the line, and that's what we're here to do. So what products can we stack on top of one another to stay within your budget, what you're willing to spend on crop insurance, but to guarantee you the most dollars back in case something, whether that was, like you said, initially everybody was talking drought, we've lost some price now. So how can we protect you moving into the future? The other thing I was going to say, I probably failed to mention earlier, if you are on this meeting, if you have some questions, you can write those questions in the chat. Farm Credit has agents stationed all over the southern half of Illinois, and we're gonna have those individuals reach out to you and answer any questions you have on these products. So what do you got going, Megan?
I think as we wrap it up, first, we want to say thank you. Whether you're watching this live or this will be available to watch later as well, if you took the time to kind of invest in us and showing you what the opportunities are for 2026. So we want to say thank you. Also, like I said, this is recorded. It will be posted on our website at farmcreditil.com/watch. So if you want to go back and watch certain parts of it, that's fine. Or if you want to share that out to anybody who maybe wanted to watch it and couldn't get on there. Like I said, any question, or like Nathan said, any questions that were put in the chat, we'll have someone reach out to you to make sure we get everybody's questions answered. And then once you close out your webinar, there will be a quick, I think, 3-question survey. And we'd really appreciate your feedback to figure out how we can keep improving how we do things to make things better for you.
I enjoyed it.
Yeah, me too.
Thank you all three for doing this today.
Yeah.